Greetings, market rebels. Welcome to this weekend's macro measure. It's actually Friday, but since we put these out typically on Sundays, going to stick with that convention for the date. So we're calling it the March 24th, 2024 edition of Macro Measure. I'm Wayne, my partner's Ryan. I'm working on this late on Friday afternoon, just in front, I think, of 2:30 p.m. here on the East Coast. Here's our trusty disclaimer. Here is our trusty intellectual property rights notice. And it is counterpoint again, but really just in a, oh boy, lukewarm way. There's just, I looked at things today. UOA activity has been very slow, so it actually works out well for me. I like when it's busy. I like when there's opportunities emerging. I guess a lot of folks are content with this to sit put, stay put for now. I'm going to leave this up. These are the notes for the week. I'll leave it up and then I'll move things. But what I'm getting at is that it fits me because I had to do some traveling this weekend. I'll be traveling virtually all weekend, so I really wouldn't be able to get to anything. Unfortunately, that's why I'm taking care of it today. And with that, let me just stop the share and then reposition things. Let's get out of that, move it over so I can see it. I'm just going to go through things point by point. This way, we get this done and we get it done more quickly. And screen 4 is what I need. And then we're off to the races and I'll get sector situation taken care of. And that way, we've at least got a little bit of information out there. But just want to show these two tabs briefly. There's been a shift. The Fed has done, I guess, what they typically do, which is talk, and then the talk really never matches up perfectly with their actions. But Powell came out and delivered what was expected, and that was taken very well by the market on Wednesday afternoon through Thursday with the gap up, and they're trying to move things up again today after opening down in SMH, which we'll look at, and then really opening in the markets. Really, they opened down a little bit, but not too much, and they're trying to work that back up in the major indexes. So maybe we'll have another week that ends on a positive note, but probabilities have slid from 33% that we sat put, which is 525-550 up here. That's where we were a month ago. We're now down to 24%. So those have slid. 1 week ago, they were at 41. Again, now they're down to 24.5. So with that in mind, the market seems to be thrilled that they're going to get their 3 rate cuts. I'll just remind everyone that historically, the performance after that is typically negative, double-digit negative in the following 12 months once the Fed starts to cut. The other note is that I guess we were never serious about meeting the 2% inflation goal, since they haven't done that, and they're already talking about, we'll be coming through with those rate cuts anyway. But that's why I say the Fed has no credibility. I've seen this a gazillion times, and I can add to that they've decreased the dollar's purchasing power by over 97% since inception. So why anybody wants them around and wants them to aid in the fleecing of Americans is beyond me, but that's why I do what I do. I don't do that other kind of stuff. So I stay away from the nitty gritty of that and whatever. But moving on to this, right, they're kind of doing the old habit both ways thing, claiming that they're tightening. But as you can see, the lower, right, the looser the conditions. So here are the financial conditions in terms of when they have gotten tight, when they've gotten loose, and you can see 0 is your dividing line there. And you can see over here that as of really about a week ago, we're at a minus 0.53. And you've got to go back to 21. This came up on Twitter, I think courtesy of, I think you were somewhere in the 2021 range. They have to get worse than this. So Sven Hendrich shared, but it just gives you an idea, right? That, oh, we're tightening, we tighten this, that, and the other thing. But really, let's say off the beaten path. They're not really that's really not the case in terms of what's really happening, and that's what we've been saying. So that money keeps those looser conditions are usually very good for stocks. They have been again. They continue to be. It's an election year. So I wanted to look at the SMH as the leader first, and the SMH is right there. Hopefully you can see we're looking at, I guess, about 1 year's worth of data, roughly speaking. And so this is the leader. This was the old maneuver that's been pulled off many a times over the years. I mean, more than I can remember, where you crack very obvious support in the form of the 20-day there in light blue, or in the form of our support line, and then you immediately turn and burn higher. And this has just been happening over and over again. There's another example of it back there. You got close here and they turned it right back up aggressively within a few sessions. Same thing happened here, right? It just, you can go back and look at what they do. This is really the nature of how these uptrends are worked these days. And they used to give people a little bit more of a chance to cover their shorts if they got caught, leaning for more of a pullback where one really didn't develop. But I've been noticing that they tend to just gap it, mercilessly on them. They engineer a gap, and then those folks are really in trouble. So they spend all day, buying at significantly higher levels and, getting taken out essentially. But for now, I think the early part of the week was a little bit of a dud. The NVDA sort of ebullient situation didn't really materialize right away. SMH clearly wasn't doing much on Monday or Tuesday, but the Fed really propelled things. And we always talk about that. You just never know what's coming up with the Fed. You never know. You can't know for sure, right? All that kind of thing. But in the end, the Fed, the Fed was that Fed announcement, the Fed Q&A was used to pull off this week's maneuvers, right? That just use those really well-known emotional potential betting events as catalysts for movement. And now they've got Nvidia, right, because of the scramble to just say awesome things about Nvidia and maybe raise target levels and things like that. We've got this Nvidia situation that's back in play in terms of it's rising. And as we all know, the way that this stock can move at times during this AI mania, whether it's justified or not, it's still really an AI mania. Well, I guess only time will tell if it's really completely justified, or maybe it's beyond justified. And these are the early days of really a worldwide panacea thanks to AI technology. But whatever the case may be, right, they've got this thing roaring back up. It's set to make an all-time closing high if it sticks here or better. So I think you've got to be careful about that. So without further delay, let's just note that the leaders are hanging in there or moving up. That's the whole point of that. This isn't done yet. They haven't cracked support yet. You can see the trailing 20, right, which is just well below where we are now, thanks to the pivot that they put in earlier this week in front of the Fed, and then the old turn and burn since. So right now, could you end up with a double top here? Sure, you could. Right now, you'd have to bet though that every time they've done this, they really came back and made a new high. So I think the odds are they probably make a new high on this, and of course that means that that the SMH gets pulled up, other things get pulled up along with it, and you maybe get to your next target. I don't want to get too far ahead, but the point is it's worked every time. And we would keep playing it that way, right, until it stops working. And really, every time this thing backed up somewhere, it found support, after a brief pullback, and just kept going. So we're going to keep going with that, even if it in your world it makes no sense. Just from a trading perspective, in the short run, I think it makes a lot of sense, and that's what allows you to just kind of boiling it down to these are the simple facts, right, of the price action. This is what allows you just to keep trading it, because with options, you have really precision control of your risk compared to stock or futures or what have you. So you can do things, you can roll very aggressively. There's all kinds of things you can do. You can play in a smaller way with slightly out of the money calls. You can do spreads, you can do whatever you want, but I would just keep playing it because these trends typically, and especially like in something that's this emotional, they tend to last longer than most people would expect them to, myself included. So I learned that you just have to keep going with it. Uh, you can prepare for what if we saw some put buying and we thought there was going to be a breakdown. There's nothing wrong with preparing for that, but if you don't get it, you don't get that break of support, and you haven't really gotten that in a meaningful way. You haven't really gotten that. You see all the SMAs rising, the momentum's still up. You see that you're about to make a new closing high. It looks like as of right now. So you got to be really careful with that. So anyway, that's what I would say on how to handle that. I don't think this is in any really big trouble until it gets below the 20. And you can see there's almost like a flat line at that 161.8 fib extension. And that's right near 857. And you can see we're not quite $100 away, but we're getting close to it. So you're a ways away. You could start drawing more aggressive supports, maybe to move things up if you really wanted to fight with this thing. But for now, I would just leave it alone. I look at it and say, let's see right here. I look at it and say, I can understand why you feel the way you do. If you're like, how do we keep buying this thing? This is insane. This thing only last fall was this whatever, a $300 stock, or I'm sorry, only last fall was this a $400 stock, something like that. I get it, but right, this is the flagship as of right now, and they're milking it for all it's worth, whether it's again justified or not. And so until that stops, it usually will boost the rest of the market in terms of the mood, sentiment, risk taking, right, risk on, all that, and it all just feeds through the entire ecosystem. So the easy money, the great story, the analysts tripping over themselves, the public's fascination, it all plays into it. So that's, if you wonder, well, why are you starting out with that, or thought this was a macro discussion? I look at it as this is part of a macro discussion, but this is extremely overbought on a weekly chart. Normally, you don't see stocks of this kind of a market cap get to a 91 reading on your weekly RSI or an 86 reading on your monthly RSI. But, this is the time and place that we're at right now. And if you're worried about that, I would say, okay, you might have even good reason to be. But the one thing I would say is just be a roller. I'd rather keep trading it from the long side and being an aggressive roller every time it takes a leap rather than fighting against it until it possibly begins to threaten to crack something. And you can just see that, one little day, one trip to the 20, and then they reverse it. That was the trip to the 20, by the way, was, not a good trading day because that was right on the earnings release the next day, right? So that was not even really, that was more of a, hey, let's shake them out to set up the earnings reaction if people are getting worried about the earnings. And they did that. But that's really not typical trading. I don't consider the times like right in front or right after earnings to be typical trading, right? That's really only maybe like, whatever, 20 days a year where you've got a few days before, a few days after, then you kind of return to normal trading. But anyway, this is still working, pulling other stocks up, pulling up SMH, which has been the most important sector. So you've got that. We probably beat that a little bit too much, but the point is hopefully made. So I would say that, look, the other things are that a lot of the sectors have participated this week. I feel like it was more reflexive, where they really weren't thrilled with moving higher in a way, but they just went along with it because, right, things are being pulled along with bull market type action. There are some less than stellar, but that's nitpicking, breadth issues. But there, to me, right, that is really nothing special. They're not too far from being just absolutely fine. So putting things in a short way, this is not a big deal. Like right now, where this is kind of a status quo report for this video this week. There's nothing extraordinary to say, well, we're really close to breaking down. We're just not. We need to probably move down about 2% in the SPYs and the Qs roughly speaking, to be able to say, well, hey, this could crack. We really need a good, really kind of a rough day, something we haven't had in months and months and months, or a rough couple of sessions to even get near the 20-day there in light blue. You can see this is just very typical, by the way. I've seen this again a gazillion times over the course of my career where the 20-day tends to serve as support, and as the market, or in this case, an ETF continues to move up and up, the trend just continues to persist relentlessly. So you would need to drop down to there. In my book, you would need to be down towards like SPY 508 if you really want to talk about a flat line or some confluence. But really, the 20-day, you want to have like a first real warning signal, not the most aggressive one I could come up with, but that's at about 513. So yeah, you've got to drop about 2% to get there, and where you'd even worry about really potentially cracking this trend in some way. So I don't think you're in any immediate jeopardy without probably really bad news developments that would suddenly turn the market over and down 2%. So, we're in a tough spot in the sense that they've moved things up now for 3 days. You could see that today we're moving down a little bit. We're unchanged now, but we were moving down a little bit. So, you're a little bit overbought maybe in the short run, but if they cool things off for a session or two, I could see them coming right back. And I think what it could be is that we've been trying to find, right, where's the catalyst, but the catalyst might be upon us finally. We have an end of the quarter maneuver they could try to put together over the next roughly 9 calendar days, or I guess it would really be 5 more market days, right, total. But the actual first quarter doesn't end, I guess, until the following Monday, if I'm not mistaken. Let's see where, yeah, April 1st is right there on a Monday. So you've got to have that. You got to get that. Usually they don't like to let things fall apart in front of booking, right, an amazing quarter of performance. And then you have, not too far after that, you've got the Q1 earnings and the hype associated with them, and the earnings season silliness that CNBC will be involved with, all that kind of stuff. But that could serve as the next round of catalysts, or it could serve as for bulls, and it could be problematic if things aren't panning out. But usually they're set to pan out, so they do pan out. Anyway, I just feel like there's been an ebbing of momentum. We do have to note that the VIX got smoked. So usually, right, VIX probably worth ignoring a lot of the time. It has been in recent years. But when it gets down here, it's been more or less a buy, right? In other words, if you wanted to, for some reason, if you wanted to acquire some volatility in some form, and the vol you're looking at is fairly correlated to the short-term VIX, the 30-day VIX, then maybe, right, it's a time for you to step in and do this, that, or the other thing. But that's just showing you, right, how probably like a really good indication of how bears must feel really beaten down at this point, because they just have not been able to get anything going. And at today's, or I should say really yesterday's low, you were not very far away from the lowest low that you registered in some time, which is at 1181. You were at 12.4 on the VIX. So the VIX is just smoked. Interestingly, right, TNX is smoked with it. It's had a rough week after failing to break out. We'll see that, right? You can see how it's really been under pressure since it reversed earlier in the week, just kind of right along with the whole Fed situation. So it is what it is, sort of a short-term double top. But the interesting thing is this dollar roaring higher. So I think you have to be a little concerned about what the driver is for this, because usually you have problems for the market when the dollar's moving up. So the dollar is looking exceptionally strong at the moment. Keep an eye on it. I don't know what's driving it. I'm going to have to look into that for us and see, what it's being attributed to. But I do think that's a little bit of a concerning sign You could see the dollar right when the market kind of started to struggle late in July into October. The dollar was doing very well. Once the market sort of began to bottom out and then roar higher into the end of the year, the dollar was getting hit. So you could see it's fairly inverse, and it is moving up. Maybe it's just lagging behind TNX, and it needs to come up a little bit more and then fail and then roll over. We'll see. But I'm going to be looking into that when I get some time. Anyway, that's something to I think, keep an eye on. I feel like overall, let's look at SPYs and NQs, but I think overall, the real simple message is, look, the trend is holding. And with the trend holding and you're not in that immediate danger, it becomes, okay, well, what am I really going to panic over, right? It's not as if like these little issues here and there are a problem yet. I think you have to really get down to where you see some kind of threat that this thing maybe had this negative divergence on some of the indicators that you like, whatever those may be. That might be happening, frankly, a little bit right now. But the reason I'm not saying, hey, it's time to panic, is just because you're away from the support areas that need to be cracked by at least a few percent. Now, if you suddenly have this false breakout, right, you fake the breakout and then you begin to reverse lower, and then you start looking at maybe this flat line here, let's call it a 430, let's see, what, 435-ish in the Qs, which maybe the 50 works its way up towards. It's not too far away with the way the math would work out. Well, maybe at that point, right, with that kind of confluence, that would be a really big break. But again, you've got to really drop down a few percent to get into that area. So for now, you're 2% away. As long as you stay 2% or more away from here, away from this level in the near future, then I don't think you're in any jeopardy, right? Other than news jeopardy of a real technical break. So it could start happening literally later today or Monday morning. But as of right now, it's away from it, right? Maybe you want to nitpick over the failed breakout yesterday and the pullback today. I don't really like to read too much into one day that often, or even 2 days that often, because it could just be the market's tired for now. People are just ready to book their gains. We'll see what happens at the end of Q1 coming up, really, with the conclusion of this upcoming week's trading a day shy of Friday due to the holiday. So, but for now, right, usually in front of holidays too it's usually good. Big US holiday, usually the performance is good. You've got the end of the quarter really happening as well. So it's hard to say without a news development that, yeah, we're going to start getting rocked here. I just kind of feel like they're going to just want to kind of quietly close this quarter out here or a little bit better and count it as a major win. So in the grand scheme, I still feel like there's issues here because this has been going on without a real pullback for a very long time. And that time that would make sense is in the near future, maybe between the end of Q1 and before the earnings really start to hit the tape. And that's really in accordance with the presidential election cycle, with this year being set to experience some of its worst performance over the course of April and May. So that's typically what happens. The cycles have worked really well, I would say, for at this point, right? We've been probably saying this for, well, I would ballpark it at about somewhere between 18 months to 2 years. The presidential election cycles have been pretty good with matching the typical performance that you see. So just keep that in mind, which that could start to impact soon. So I don't think we're in the second inning, that mainly because of the calendar. And I kind of feel like some of this buying is starting to look tired. I'm seeing some what I would call distribution. They're using some nice moves to kind of sell and just sit there and impede progress. Now that could just be temporarily, could be some profit taking, could be some rotation, but what it is what it is. It's still, I think, people liquidating longs to people that are Johnny come latelys, which, if you're just started to buy and think things look really good now, clearly, right, you're late to what's been a tremendous party for 6 months, just shy of months. So I think that you had fresh shorts. We talked about that last week. They did it to themselves again right in front of the Fed. Seems like that whole gang can't help themselves. You've got the loose financial conditions. You've got we already talked about the election year. Inflation does remain undead, if you ask me. But again, what Powell's saying now is that, hey, I'm abandoning a lot of my prior comments, and so are all the other Fed speakers, I guess. Right. So this is me talking about, this is how they just change, right? They change the rules. Well, we're going for a target of 2% inflation. Well, we never really got there, but we're going to be easing anyway. Right. So that's just the moving, as people say, that's the moving of the goalposts. It's an election year. This is typically the kind of stuff that you see. They're trying not to be political by, according to some articles, and that's why they're going to rush a rate cut sooner. And that's why the June meeting looks like that'll be the one. But that is political, right? When you're actually you're actually trying to rush it sooner than you really think it should have happened, and it hasn't even met, right, with your rhetoric. Your rhetoric hasn't been matched by reality, but you're doing it anyway. So whatever the case may be, anybody could lament that nonsense all day long, but it is what it is. I still think that the action looks promising big picture. I'm just more of a concerned short-term player really in the next month. And I think you should probably see some kind of a more realistic pullback. And again, the whole time I've been saying that I don't think it should really be anything incredible where there's some kind of a crash, unless, of course, there's news developments that we're unaware of. That would, for me, would probably be financial system. A lot of times these things start in Asia or Europe or both, then they start to fester and they spill over. Sometimes we've had problems here in the US. There's regional banking concerns here and there, but they've done a really great job of not allowing those to really be focused upon, right? And not many people are thinking about them. And so if you start seeing the VIX really get smoked next week in front of a long holiday weekend, maybe they're acting bullishly to print Q1's end, as I said, and you get really smoked there, that could be, right, you get down to with an 11 handle or something like that, or maybe even make a new low. That would be a sign of complacency, probably, given the timing of such an occurrence. So just keep that in mind. I'm still sticking with the fact that IWM and XTN are not breaking out. They are not, right, you kind of have this false breakout sort of in IWM. You have XTN that finally started to come back, but it still has yet to break out and really has not been able to join this market's party. It's trying again after finding the 200 there in purple and bouncing, really right in line with the whole Fed setup. But I just feel like we're kind of ending this week on we use that catalyst exactly how you would expect us to, but now we don't really want to buy anymore. It's kind of like it was more of a trade for the players on balance rather than long-term positioning. Again, it could change on Monday morning, but you get the idea. Let's see. Oh yeah, and again, TNX is reeling, and IWM really should be doing better, right, with rates rolling over, but it's not right now. Now this could be options expiration related. It is still above all the SMAs, even though it's having a poor session. It is a very squirrely ETF at times. So maybe it's just going to close this kind of sort of like a gap here, pull back after a burst, and then find a higher low and go. I do have an idea in for a breakout because it really is lagging and rates are dropping as of now. So I think it's about to have its best opportunity to put a little bit more of a real breakout together. But it's touched this breakout zone near, say, 206-ish or 204-ish, 205, 204 a few times. And so if it were to come down and hold there and go again, that might be a good sign that it tested it a few times before really launching, if it does launch. But that could be tough. It's a good trader, but it can be really tough to uh, make heads or tails out of it at times. What's exactly going on at the moment? I think it's just really like a pure price action beast, pure vehicle at times that you just, you don't overthink it and just trade it, type of a thing with the charts. So you heard about what I think could be the next catalysts. I did talk about how I think that the hedgies got drawn in with fresh shorts last week. We said we may have seen those. I do think, right, that instant kind of whoosh higher there that they put together on the Fed, that was aided by that. Again, I reiterate that I still see some distribution here and there. I think of late, it was a little stronger last week, and a little earlier this week, but clearly, right, the squeeze has been on ever since the Fed took center stage. The banking system, I already mentioned, to me, that could be a problem area, just going through the notes. The precious metals, I'll talk about this in sector situation, but precious metals, with the dollar ramping up and those having been short-term overbought, they're pulling back a little bit. So I think they like the overall, hey, we're going to be looser with money all over again, because that hasn't ever led to any trouble in history that the Fed put out. But the dollar's just ramping the last two sessions, I think, has put those under pressure. Okay, just kind of a note there on that. But the other thing we could mention is that after doing really well, oil, which I'll talk about a little bit in sector situation, but oil and copper, just in macro picture, a couple of things to keep an eye on. They kind of, again, dollars strong, so we can understand part of this, but dollar strong the past couple sessions, I should say. But why am I not getting the G? There it is. But yeah, these two just were doing well, and they were probably getting a little ahead of themselves short term technically, and in terms of overboughtness, blah blah blah. So they're both more or less in pullback mode. They bear watching, obviously. Things have been starting to get better and better for copper. We've been waiting to see something for a long time. So we kind of have a breakout there from the range. Now a pullback to the top of the range, which was former resistance, and maybe they can convert it to support. So that could be worth keeping an eye on. We don't use it as a trading vehicle, but that could be a good sign, right? That maybe globally, it's starting to just have an effect globally, and things are picking up a little bit. They're not worsening, that kind of a thing, which would be welcome. Let's see. I still think from now through really April is our target for, if we're going to see something, that's when we should see it. And I don't know what would cause that. I've speculated about a few things that could or historically have, but that's about it. I would say that I think risk. So I do think risk will come back in the next 5 weeks in some way. I think it makes sense at the start of the Q2 rather than next week, but again, you never know. I do think you should revisit your downside butterflies, and if things have moved up and some of the things that you would consider putting on downside butterfly in, then you should just maybe revise your strikes. Remember, we have never traded these. We're just keeping them in mind in case, sensing that maybe we're in the late innings. If we are in the late innings, you might get a real pullback, and you could start working with a nice trade there that could maybe serve as shock absorbers for your other longs or what have you. Or maybe you just go neutral and then add those, and you're more of a short-term bear with not a lot of dollars at risk. Anyway, just to touch on that, I do think, again, just reiterate, still relative risk-wise, I think we're elevated. There's still the downside gaps they've never filled. There's the lack of a real pullback. I do think the market's lost some of its swagger the last couple of weeks, but as I said, we're at least 2% away from real danger. So as long as we stay here or higher relative to those SMAs, right, there's no reason to go into panic mode anytime soon, unless you spot some other developments like, well, here's the real reason why the dollar's screaming, or this is what's going on in Asia in terms of banking or what have you. That kind of a thing naturally might override it and get some hedges on even before the before it impacts here, if you really think it will. As I've been noting, though, the trend has been excellent to trade since the October lows. October is when most things made their lows. Right afterwards, we not to toot our own horn, but we did note that we wouldn't take what was happening lightly in terms of the end of the year and then what they could do from there and how we might rise to new all-time highs. And the reason why we said that is because of the election cycle, right? The election cycle, the two best years tend to be last year, the third year of the presidential election cycle, and then the fourth year when they actually do hold the election, which is this year. Those tend to be your two best years in that order, third being the best, fourth being second best. And without, basically sensing that maybe the Fed had hit their zenith in terms of where they would raise things to, that you'd start to see maybe things finally cooling off inflation wise, and then that would allow for things to start to really stop hurting the consumer even more, and then you would end up with a situation where things sort of return to more of a stable status quo, with an eye towards, if there is weakening in the economy, then they start to decrease rates, and ultimately, that's a good thing for the market typically. But the market's way ahead of itself in some ways, and the market could have it right. They could have started their buying extravaganza. They've really started it on time as per that election cycle, let's say cyclical type behavior, performance, whatever you want to call it, historically, empirically, but they might have it right. Some people, myself included, would say I think a lot of this is overly optimistic. It doesn't leave room for any issues. At the same time, it could be that, no, I'm wrong and they're right, and the whole market is right to just keep buying because they see things really panning out. I feel like they've, as usual, by the way, this is nothing new, set themselves up to price things to perfection. I do think what you can get in the form of dividends from owning the S&P is now less than what you can get in some sort of an interest-bearing vehicle. So I think certain bonds at this point are actually yielding more. Owning the bond is yielding more than the S&P 500, which again, that the so-called risk premium. So that's not really a good thing, right? Ultimately, that's really more people tend to switch to something they perceive to be safer out of equities when they can get a better yield when they feel that, especially when they feel that equity prices are elevated. So some people do, some people don't. We'll see how it all shakes out. Obviously, that's the great thing about being in the market over the long haul. You get to learn from it. You get to see how things shift. So I think that there could be a real comeuppance for the market at some point. But I would not fight this at all until we continue to say that and they continue to keep it away from trouble. So until it gets near a trouble zone, right, I don't even want to really pick fights with it. Every now and then I'll put in a counter trend idea where I'm interested in like a small sort of, maybe get a single or double in terms of a score, a small pullback, and that's it, right? And then you just take your money and say, I'm happy I was active, I made money against the trend. And then the smarter move is to not only make your money on the short side, but then reload your longs and go back for the resumption of the trend. But here's this IWM. And like I said, if you want to put levels out here, I'll put those out really on the big three. I don't think you've got to worry about anything that would open up bigger downside. We switched over to percentage until you get below the 20, and that's it. That's down about $1.50 from where we are right now. So that is actually closer. Like I said, to me, it's a little interesting because why is it? I can see why it's struggling today, and maybe even yesterday, why it didn't do more with the dollar rising. But with yields falling, you would think this is really a great opportunity for it to do better. And it just isn't. It's not really delivering yet. But maybe we're just expecting too much too soon. It has obviously had tons of fits and starts, but I don't think you've got to worry about anything till below 204. That to me wouldn't constitute the trend cracking, by the way. I think the 50 is really where you start to get much more worried, and that is at 199.42, right? That's been an area right near the big round number that Greg likes to talk about. That's been the big area there. You can go back right to here. It's like 198, 199, 198.75. So right near there is the key area, right? If it does in fact drop that low, but the other things keep screaming, and you see yields rolling over. This thing starts to catch a bid. I mean, it's got a lot of catch up potential, so it's one worth keeping an eye on, I think, for that kind of a sudden, like really big move, much like you saw in here, where they really put a really big couple of days together. That's the kind of thing that could happen, I think, if yields continue to roll over hard. We'll see, right? We'll see about that. Spiders, let's make sure that everybody knows where they get a little concerned about that, which is the 20-day for me. This is at least how I view it. You might not view it that way, but things are not ultimately, like right now, things are not super overbought in the short run. They're more or less overbought on bigger picture charts, like weekly charts. But 513 would be where I'd get concerned about it right now on the SPY. Otherwise, right, you made a new all-time high yesterday on the post-Fed impaling of anyone that stayed short. So, which is, again, that's been the game. That really is the game. It's the short-term trading game. That's what that's turned into, just a series of these guys load up thinking they're going to nail the rollover, nail somewhere near the high. I'm talking about the hedge funds, and then they get short too aggressively too soon, and then a whole nother round of squeezing happens after the catalyst plays out, or at least is made to play out in the favor of the bulls. So this is your cues. It does look like it has a little bit of another gap here that still hasn't closed. Probably would have been ideal for them just to dip a little more than reverse, because that would make some people feel better about it. But maybe they want to keep the party really select among themselves. But anyway, big gap that's back there. We talked about there's gaps throughout this whole thing, but I think really, I talked about this earlier, I don't think you really have to worry about anything. I think you have to, basically, you may as well just say that these recent lows are close. If that way, you be about 434. So again, you're down about 9 to 10 points. That's another about 2% from where you are right now. And otherwise, right, I'm not really worried. Now, if you really go into a stall mode and you stop making progress, naturally these SMAs are going to find a way to keep catching up. So if they don't do something with it, right, and we have kind of a lackluster shortened week, holiday week next week, 4 sessions, and these things kind of grind their way higher, then the breakdown for the immediate counter trend trade, short-term trade, becomes a little bit closer. But I still think for the bigger problems, if you're looking for, hey, this thing's really in trouble, I think you've got to get to the 50. That's, to me, still there. And that, to me, is 431.28. So that's probably about 3% away. So I think you could conceivably drop about 3%, 2.5 to 3%, and still not really have a problem on your hands. So that's all. That's what I would share that way. I don't think for macro measure there's anything else that it's worth really for me covering right now. So I'll let that go. I don't think there's anything else that's worth sort of slipping in here. I will cover some sector situation stuff shortly, and we'll get those videos out. So I wish everyone a great conclusion to their week, since we've got 50 minutes to go. And I wish everybody a great weekend and a great upcoming shortened trading week and holiday weekend to follow that. So everyone take care, and thanks for tuning in.